This is Talking Capital Markets, where ideas drive the markets. We move past the headlines and into the heart of the deal, breaking down IPOs, M&A, governance, and the strategies driving real growth in today's capital landscape. No noise, no hype, just conviction, execution, capital in motion. If you're building companies, raising capital, advising boards, or deploying investment, you're not just listening, you're in the room. And now, here are your hosts, Mike Blankenship and Brian Jue.
Welcome to Talking Capital Markets with Mike and Brian. I'm Brian Jue.
I'm Mike Blankenship.
Today, we're going to talk about the return of the emerging growth IPO. Is this something that we haven't seen as much recently? We've been just seeing these big, gigantic, gargantuan IPOs, and everyone wants that unicorn status, that billion-dollar valuation. But what a lot of people don't realize is that not too long ago, going public was a way for emerging growth companies to get capital, get liquidity for their early shareholders, and in a lot of cases, even startups would go public to raise their money. And I know this because I was a part of that world in the 90s and the early 2000s. It was common for a company to go out and do an IPO for $5, $7, $10, $15, $20 million. And today, we don't see it as much, but we see that market coming back. Right, Mike?
Yeah, we do. I think when, the emerging growth company came about in 2012 under the Jobs Act, that really created a pathway that could do it. But then we saw, SPACs, IPOs, the bigger IPOs kind of pushed that aside. But now we're starting to see a lot more of that for a number of reasons, in my opinion. One, private capital is tighter. It's harder sometimes, and they're certainly more selective. And we get later in the game, and you try to get bigger and bigger, the structure gets more complicated. And as a founder, you start losing that control. And so one way to maintain some of that is to be more competitive, pick up good revenue in the $50 to $300 million range and try to be as good as you can be there. And doing it early on as emerging growth where you come out raising 10, 15, $20 million really can set you up for, a good runway for at least a year or two. And then having that flexibility to go back and forth is important. So I do think we're starting to see a lot more of that emerging growth companies resurface and come out. And some of them are going to be really strong coming out because I think that market is, heating up.
I think we also are fighting with a narrative that a lot of the big VCs and the institutions have. And basically, that's you have to be of that certain size. Well, basically what they're doing is they're creating an exit for all their rounds and the need for them in the first place, right? But before, what if you didn't have access to that kind of VC network? What if you couldn't get to the big VC that could get you there in the first place, or the right investor, right institution, whatever it might be? And so going public was a way companies became giants. I mean, if you go back and you look at Microsoft and Amazon, and before that Apple, and where they IPO'd and at what point in time their companies IPO'd, if those companies were trying to do that today, a lot of the big players would say, well, you're really just a Series B, a Series C, or something like that. But today, things are changing, right? And Mike, you've been a part of big IPOs, billion-dollar IPOs, but you also see that the market can change right now, and this can become a place where companies that are trying to get that first run out there, trying to grow and have that chance of success that they might not have otherwise.
Yeah. I mean, I think being part of that, it's fun. I think these companies really are trying to be something. And they are putting in that aftermarket discipline that's important for a company to the one, you pointed out a couple good examples. Those will all be small caps in today's market. But clearly they've done a lot of right things to grow the way that they have, and certainly evaluated and showed sort of use of proceeds and were conservative in the way they projected out. And so I think we're going to continue to see a lot more of that as noted. I think they're educated companies. They've become certainly more educated. So they're getting more information from folks like us about how to do it and do it right. And I think more can be phased into the public markets, and we'll see a lot more of that going forward.
So let's talk about that for a little bit too, about being publicly traded and being publicly traded on the New York Stock Exchange or NASDAQ as a emerging growth company. There's a lot of advantages. Yes, there's certainly cost involved and there's certainly level of transparency you have to have that you don't have to have as a privately held company. But let's talk about your valuation. Let's talk about access to capital, using your publicly traded status as a currency, all of the above. Those are all tools to growth that companies are always looking for.
Yeah, I mean, those are ways to get there. I think it's the steps, how you get there, and being smart about it. Look, if you've got a company that is in a particular industry where there's going to be future growth, I think that's one that we have to kind of, you really need to focus because, as the saying goes, the PO market windows open and close all the time. And we've seen a pretty closed window for the last few years, not a very wide open window. But I do think in this market and with small caps and with some of these micro caps, there are opportunities there because these are ones that maybe early on, but they're certainly emerging where they could put sort of things to work and really fuel the fire with the IPO.
So let's look at this other aspect. Now, there's obviously, especially when you're talking about tech, a lot of these founders in tech have this vision that they all need to become, Zuckerberg, Musk, Jobs, Gates, right? They have that dream and the vision. And I don't want to say no to that, right? Because, I believe in having goals and dreams, but when you go this route, and let's say you take your company out and you can justify a 10, 15, $20 million IPO, that could be the start. But if you do what you're supposed to do, there can still be that much bigger exit through a secondary, right?
That's right. So you have the ability to go out and do that. I think you shouldn't chase it and you should really do what's right for your company. And there is that opportunity on a secondary or even on a primary that's a follow on offering where you can do even more, grow more, with the right company and the right story, will help you get there. So again, don't chase it. I know you're in North Carolina, but one of the best interviews Michael Jordan did was the one with Oprah talking about not chasing. You don't chase the dream. You go and work hard at what you're trying to build and do. And so I think if you're looking at all those founders that you mentioned and you're trying to be them and copy them, I don't think that's the right way. I think you have to be a company that's paving your own path that works hard to get to where you need to be.
Absolutely. I agree with you wholeheartedly there. You got to do you. And I think too often companies and founders kind of lose sight of that. But those that do, those are the ones that win.
Yep, absolutely.
That capability though, of being able to get out there, get public and grow. Well, there's also the aspect of acquisition. And I think sometimes, and this is probably something we should talk about too in another episode. I think a lot of companies don't realize that when you go out there and make an acquisition or a combination, that you could be the surviving entity even if you're smaller size wise, or revenue wise than the entity that you're merging with, right?
100% because you're going to be it just depends on the accounting, but you could be the survivor, and therefore, maybe your management comes about. Maybe there's something about the company, your company, that's going to give a better story. Maybe spin off something from the other acquired business. So yeah, there's definitely different ways and structures and strategies around that, and being public allows some of that, a lot more of that flexibility because ways you can pay for it, ways you can structure it a little bit differently than if you're just a plain private company.
The current Invest Act in 2025, how does that work with the Job Act of 2012? Do we see this truly making things easier for IPOs moving forward?
Yeah, in its current state, it will expand a lot of the emerging growth things that were in the Jobs Act, and so the Invest Act will help kind of build out a lot more of those to allow companies to um, you know, go public as we were talking about earlier. They can do it now, but there are certain things that hold them back, and expenses are there. And I think there are some other issues that hold them back, especially around audits and other kind of issues. I think that expansion will really help. I think you've got a lot more, uh, regulatory support or regulation and support around that. Meaning there's certainly less of it. Uh, and for those that don't know, the Invest Act, Invest is improving venture, early stage, and small cap access to public markets. So it's literally trying, by in its name, trying to do that. And hopefully, this is one of those bills that its name actually means what it is. And so, it's certainly, hopefully, increasing the volume of the number of small and mid cap companies, and not just the big behemoth ones that are out there. So I do think you're going to have a lot more ability, when you go out and test the waters, when you do various things in there. So I think it's a good, hopefully a good act, well intentioned to get things done.
Oh, that's great. I'm excited. I'm excited. That's for sure.
Yeah,
Well, I think that was a great episode, Mike. Thank you. Thank you for joining us, Talking Capital Markets with Mike and Brian. I'm Brian Jue.
I'm Mike Blankenship.
Join us next time.